The Bank of England held interest rates at 3.75% on Thursday for the fourth consecutive meeting, and sterling fell. That is the first thing to register, because a hold that causes the pound to drop 0.6% to a 10-week low of $1.3212 is not functioning as relief. The bottleneck is inside the vote. 2 of 9 Monetary Policy Committee members, Hugh Pill and Megan Green, voted to raise rates to 4% immediately. That dissent is the signal the headline number buries. Governor Andrew Bailey framed the decision carefully. Oil prices have fallen after the US-Iran peace deal. That part is real. But Bailey added that whatever happens in the future, the higher energy prices of the past 4 months mean there's already some inflationary pressure in the pipeline. That phrase, in the pipeline, is doing the analytical work. The peace deal has not unwound 4 months of energy cost accumulation. It has only stopped the pipeline from getting longer. The hold was the right call by the 7-member majority's own logic. UK inflation printed at 2.8% in May, below the forecasts that had traders pricing in 3 hikes just weeks ago. The labor market is loosening, with job vacancies at a 5-year low of 707,000. A hike into that data would have risked accelerating a slowdown. But the 7-2 split tells a different story from hike firmly off the table. It tells a story of a committee split between a recession risk and an inflation risk, with neither side yet having enough evidence to force resolution. 2-year UK gilt yields rose almost 7 basis points on the day, to 4.2%, even after the hold was announced. That is not the bond market celebrating a pause. That is the bond market repricing the probability that the pause is temporary. The MPC minutes made the mechanism explicit. Mortgage rates and business loan costs have already risen significantly since the Iran conflict began, reflecting full and fast pass-through of those market moves. The bank has not raised rates. The market has done it on their behalf. This is the buried assumption the consensus has not fully absorbed. Many commentators describe the hold as stability, and the mortgage market subsequently cutting rates as confirmation that the worst is past. But those mortgage rate cuts are tracking swap rates, which themselves track gilt markets, which today moved up. The direction of travel for fixed mortgage pricing in the weeks ahead will depend not on what the MPC did today, but on what traders think it will do in July. Goldman Sachs Asset Management's Simon Dangor noted the BOE likely has room to assess the energy shock before taking decisive action. Aberdeen's Luke Bartholomew added that if energy prices continue to moderate, the debate could once again turn to rate cuts, but that might have to wait until next year. These are 2 institutions drawing opposite conclusions from the same hold decision. One reads it as patience before tightening, the other as an eventual path back toward easing. That disagreement is not rhetorical. It is the actual uncertainty the market is pricing, and it is priced through sterling, not through the base rate. The ECB comparison sharpens this. The European Central Bank raised rates last week for the first time in almost 3 years, explicitly citing the conflict's inflationary pressure. The BOE chose to hold. That divergence sent sterling lower against the euro, which rose 0.25% against the pound. Traders are not reading the BOE's hold as a sign of strength. They are reading it as a constraint, a central bank that wanted to hold, but whose own committee showed it is not unanimous about doing so for much longer. The buried assumption inside the 7-member majority is that the Iran conflict inflation spike will prove temporary. Bailey called it tolerating temporarily above target inflation as part of a return to target. That framing only works if the pipeline drains on schedule. The problem is the Ofgem energy price cap, scheduled to rise by more than 10% in July, approximately 4 months after the conflict's energy shock was absorbed into futures markets. This is not a hypothetical risk. The mechanism for determining domestic energy bills in the UK delays pass-through of market prices. The July cap rise is a committed future event. JP Morgan revised its UK inflation forecast to 2.9% for the second half of 2026, up from 2.2% before the hold decision. The bank pushed its forecast for the first Bank of England rate cut to the first quarter of 2027. The logic is specific. Even if oil stabilizes at lower levels after the peace deal, the energy cap mechanism means domestic inflation will still accelerate through Q3. The bank itself acknowledged that CPI is expected to pick up to a little over 3.25% in Q4, which is its own downgraded estimate from earlier worst-case projections. But it is still a pickup, still above target, and still arriving in the window before the 30 July MPC meeting. The consensus holds that the 7-member majority is stable. That assumption requires the July inflation data to come in without surprises, and the Hormuz reopening to proceed without disruption. The Deutsche Bank reading, growing consensus for a long hold, is the dominant institutional view. But it was also the dominant institutional view in May, before 2 members shifted to voting for a hike. What changed was not a single dramatic event. It was accumulated pipeline pressure reaching an inflection point. The July Ofgem rise is the next such inflection point. If the August CPI print reflects it strongly, the 7-2 split becomes 6-3 or closer before markets have time to reprice slowly.
There is a genuine counter-argument to the tightening thesis. The U.S.-Iran peace deal is real, signed today. Oil fell to $77.99 a barrel. Mortgage providers have been cutting fixed rates in recent weeks as swap rates declined. If the Strait of Hormuz reopens cleanly and oil stabilizes below $80, the pipeline Bailey described will drain faster than current forecasts assume, and the 2 dissenters will lack new evidence to recruit further converts. That scenario leads back toward rate cuts in 2027, not a hike in 2026. The evidence as it stands does not yet favor that outcome decisively. The peace deal was announced this week, not a month ago. Its pass-through into Ofgem cap projections has not yet been recalculated. The 2-year gilt yield rose today despite the hold. Markets are still pricing 1 hike before year-end. These are not fear signals, they are uncertainty signals, which means the decision variable is not resolved. For a holder of rate-sensitive assets, gilts, house builder shares, tracker mortgages, the immediate move is unchanged. The hold provides no new tightening pressure today, and swap rate-linked mortgage pricing has been falling. The posture is to watch the Ofgem July cap announcement and the subsequent August CPI print. If CPI approaches or exceeds 3.25% as the bank projects, the probability of a July or September hike rises sharply, and the 7-member majority faces its first real challenge. For a watcher considering fixed-rate mortgage commitments, the relevant signal is not today's base rate, but the swap rate trajectory over the next 3 weeks. If those rates rise as Hormuz reopening proves slower than priced, the window for cheaper fixed deals narrows before the July meeting. The 30 July MPC decision is the first checkpoint. The July energy cap is the variable that decides what that meeting faces. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.